Hi, I'm Kerry Craig, Global Market Strategist here at JP Morgan Asset Management. In this video, I'll be sharing our view on what central banks' tapering of bond purchases means using our fourth quarter guide to the markets for Australia. Inflation around the world has been higher than anticipated, and while some of this inflation will be transitory, there is a risk that price pressures from tighter labour markets and higher wage growth lifts inflation expectations. Central banks are responding by starting that process of normalising their policy settings. For example, the US Federal Reserve currently purchases $120 billion of government bonds and mortgage-backed securities each month. Since the US economy has made substantial progress in its recovery, it is likely that the Fed will start to reduce the pace of those bond purchases later this year. It is important, however, to remember that tapering is not tightening and that liquidity is still being added, just at a reduced pace. Investors may be tempted to draw parallels to the last time the Fed undertook tapering in 2013 and 2014. Now, while that experience may provide a rough guide, there are many differences between now and then. For example, both equities and bonds trade at a much higher valuation than they did in 2014. Meanwhile, the momentum in the economy is stronger now and the earnings outlook more robust. Perhaps of greatest importance will be how investors seek to protect their portfolios against risk when safe haven assets like government bonds face such a challenging environment. While we expect that negative correlation between bonds and equities to hold and offer some protection should there be a meaningful shock to equities, that degree of protection has declined. Adding additional diversification through alternatives and hedge fund-like strategies may be one option. In summary, the Fed starting to slow down bond buying is an important change, and other central banks are becoming more hawkish. Yields will rise on government bonds, and the segments of the market that are geared towards reopening and reflation may start to outperform. Credit is likely to be well supported even as spreads have narrowed, as default rates remain low and investors look for income. Alternatives can provide another source of alpha as well as diversification for investors. Thanks for watching.